CleanSpark Inc., Nasdaq ticker CLSK, is currently trading at $13.45, reflecting a massive intraday surge of plus 1.63 points, or roughly 13.79% in active trading. You are watching the ticker turn green. You are seeing the percentage climb double digits, and the first instinct is to assume this is just another day in the crypto markets. You see Bitcoin moving, you assume CleanSpark is simply drafting behind the digital asset like a cyclist in a peloton. That is the expectation. It is the easy narrative. It is the comfortable explanation that keeps most retail investors on the sidelines, or worse, chasing the wrong metrics. But the reality of what is happening on this chart right now is significantly more complex and, frankly, far more aggressive than a simple correlation trade. What we are witnessing is not just a mining stock rallying with Bitcoin. We are watching a company fundamentally reprice its entire existence, from a pure-play cryptocurrency miner to a hybrid infrastructure giant. The market isn't just buying Bitcoin exposure today, it is buying a massive, unexpected execution beat that contradicts the bearish sell-the-news sentiment that plagued the pre-market session. Let's strip away the noise. The general belief, the street view, was that CleanSpark's fiscal 2025 earnings would be a show-me moment where margins compressed and the realities of the post-halving world crushed profitability. The expectation was for a company struggling to maintain efficiency while burning cash. The reality, CleanSpark just delivered a financial report that didn't just step over the bar, it dismantled the entire apparatus. They reported earnings per share of $1.12. Let that sink in for a second. The consensus estimate, what the smart money and the analysts with the spreadsheets projected, was just 28 cents. That is not a beat, that is a 300% operational anomaly in the best possible sense. We are talking about a company that the market expected to scrape by, instead posting a net income turnaround of over $360 million compared to a loss the previous year. This price action at $13.45 isn't speculation. It is a violent repricing of fundamental reality. When you look at the volume today, hovering near 70 million shares, it tells you that institutions are likely scrambling to adjust their models. This isn't just retail traders on Robinhood or SoFi flipping contracts. This volume signature suggests that the large-scale capital allocators who wrote this off as just another miner are now forced to confront a balance sheet that has grown its revenue by 102% year over year to nearly $766 million. The tension here is palpable. You have a stock that was pinned down by short-term fears regarding the AI pivot, the concern that mining companies chasing artificial intelligence contracts are distracted and diluting shareholder value. CleanSpark has effectively looked at that narrative and countered it with cold, hard cash flow. The $13.45 price tag is the battleground where the Bitcoin purists and the AI speculators are currently shaking hands. Let's zoom in on the specific mechanics driving this movement right now. We have seen significant volatility in the last 48 hours. Following the earnings release, there was an immediate, almost reflexive dip, a classic algorithmic reaction to headline confusion or perhaps profit-taking from the run-up. But as the details of the 10K filing were digested, the buyers stepped in with conviction. Why? Because the company confirmed it has secured a war chest. We are talking about a $1.15 billion convertible note offering. Now, usually when you hear convertible note, you think dilution, and the stock tanks. But here, the market is interpreting this liquidity not as a desperation move, but as an acquisition weapon. CleanSpark isn't raising cash to keep the lights on, they are raising cash to buy the power grid. They are acquiring land in Tennessee, Wyoming, and expanding aggressively in Georgia. In an environment where power, actual gigawatts of electricity, is the new oil, CleanSpark has just announced it is swimming in it. To understand why this stock is commanding this premium today, you have to look at the operational efficiency. This is the boring part that no one talks about at dinner parties, but it is exactly why the stock is up 13% and not flat. CleanSpark's fleet efficiency is hovering around 16.7 joules per terahash. For those who don't invest in individual brokerage accounts specifically for crypto miners, let me translate. That is elite. In a post-halving world where the reward for mining a Bitcoin is cut in half, the only way you survive is by being the most efficient operator in the room. If you're running old machines, you're dead. CleanSpark is running the Ferraris of the mining world. They produced over 7,800 Bitcoin in the fiscal year. They hold over 13,000 Bitcoin on their balance sheet. At current Bitcoin prices, that treasury alone is a fortress. But here is the contrarian take that challenges the bullish euphoria. Despite this massive beat, analysts are cutting their price targets. You heard that right. Firms like Macquarie and B. Riley have lowered their targets, some to $27, some to $22. Why? If the earnings were so good, why is the target coming down? This is where you, as a smart investor, need to read between the lines. These analysts are pricing in execution risk. They're worried that CleanSpark's ambition to enter the HPC space, renting out their data centers for AI training, is going to be costly and difficult. They are hedging their bets. The market today, trading at $13.45, is telling those analysts they are wrong. The market is betting that CleanSpark can walk and chew gum at the same time, that they can mine Bitcoin at elite margins and build out an AI infrastructure business that rivals traditional data centers. This brings us to the AI pivot, which is the single most critical catalyst for this stock moving forward. You have heard the buzz about miners shifting to AI. It sounds great in a press release, but CleanSpark is putting steel in the ground. They're repurposing the Sandersville, Georgia site and Metro Atlanta locations for HPC. They are targeting 200 megawatts of critical IT load for this transition. This is not a pilot program. This is a structural evolution of the business model. By diversifying into AI, they are effectively hedging against the volatility of Bitcoin. If Bitcoin crashes to 30K, the AI contracts keep paying. If Bitcoin goes to 150K, the mining fleet prints cash. It's a dual-engined aircraft. The investors buying at $13.45 are not paying for a miner, they are paying for an energy infrastructure play that happens to mint cryptocurrency. Comment below. Do you think the AI pivot is a brilliant diversification move for CleanSpark, or do you think they should stick 100% to Bitcoin mining? I want to see the debate in the comments. Are you here for the crypto or the compute? Let's look at the financials again because the magnitude of this turnaround cannot be overstated. Fiscal year revenue of $766 million is a 102% increase. But look at the adjusted EBITDA. It skyrocketed to $823.4 million. Now you might notice that EBITDA is higher than revenue. That's due to the accounting treatment of their massive Bitcoin holdings and the appreciation of those assets. This highlights the unique leverage CleanSpark offers. When you buy Apple stock or Tesla stock, you're buying a company that sells products. When you buy CleanSpark, you are buying a company that manufactures a commodity, Bitcoin, that has appreciated significantly while simultaneously building the factories, data centers, to house the most valuable technology of the next decade, AI. But we must address the risks. We cannot ignore the short interest. There is a significant contingent of the market betting against this company. The short thesis relies on the idea that the global hash rate, the total computing power of the Bitcoin network, is rising so fast that CleanSpark's share of the pie will shrink unless they keep spending billions on new machines. It's the Red Queen problem, running as fast as you can just to stay in the same place. This is a valid concern. If CleanSpark stops expanding for even a quarter, they fall behind. That $1.15 billion they raised, they have to spend it. They have no choice. They are on a treadmill that is set to maximum speed. The bullish argument is that they are the fittest runner in the gym. The bearish argument is that the treadmill eventually wins. Furthermore, we need to talk about the energy markets. CleanSpark's advantage is access to low-cost power. They have roughly 1.3 gigawatts of power under contract. In the world of Fidelity ETFs and Schwab Intelligent Portfolios, energy is usually a boring utility play. But for CleanSpark, energy is the raw material. If regulatory environments in Georgia or Tennessee shift, or if energy prices spike due to macro factors, their margins get squeezed immediately. They're essentially an energy arbitrage fund. They buy electricity at wholesale rates, run it through ASICs, and sell the output, Bitcoin, at market rates. The spread is their profit. Right now, that spread is healthy,